Hello and welcome to CAP STRAT this week. Jerome Powell talks and the markets listen. We certainly listen. So we can dive into that. That was obviously a big mover last week. But first, wanted to kind of set the stage with our viewers and help them understand how we look at markets. We spend a lot of time on these videos talking about the investment framework, right? The quantitative things that matter, valuations, inflation, liquidity, economic growth, and recession, right? But what we're introducing here to a broader audience today is our market regime framework. So the way we think about it is the investment framework helps us determine long-term attractiveness. We overlay that with this market regime framework that helps us get a gauge on what the market broadly is expecting and how it may react to certain changes in those investment framework factors. So, Mike, we've got a nice colorful chart here. We've got the S&P 500 index price level, the Bloomberg Ag Bond index price level. Walk us through, what type of market regimes we've been seeing lately and what that means for these price level charts.
Yeah, one way that we talk about it internally, thinking about our investment framework versus market regimes, is if our investment framework says the water's going to be warm 12 months out from now, what the markets might actually do between now and then is cycle between extremely hot and extremely cold to an average that is warm.
Sure.
Right? So that's where the market regimes come in, sort of that hot and cold nature of markets on the in-between times and explaining and understanding that volatility.
Right.
And so since the beginning of 2022, we've had 4 dominant market regimes. One of them is relatively new, the purple, the immaculate landing, but they're all related to the Fed's effort to quote unquote land the plane. And when we talk about that, what does that mean? It means bringing inflation down to a more sustainable level, something around 2%. And in order to manufacture that, very carefully navigating interest rates to not do any undue harm to the economy.
Right.
A safe landing. And that landing could be a number of things. There could be a no landing, meaning they're not doing enough to land inflation, to bring it down to a sustainable level. There's a bumpy landing. Yeah, we're going to land the plane, but it's going to be a rocky ride. Maybe unemployment is going to rise. Maybe the economy is going to hit some speed bumps. Maybe we're not going to be able to cut rates down to a nice level like we're used to, prior to 2022. The hard landing, that's the oh no scenario. That's where, in an effort to bring down inflation, unfortunately, you push the economy into a recession.
Yep.
The hard landing, surprisingly enough, we've only been in that market regime for a very short period of time. The market has only really had legitimate recession fears priced into forward-looking indicators in March of 2023 when banks were failing, and It was relatively short-lived. That's shocking because if you were to ask the Fed back at the beginning of this time period when inflation was running at 6% plus, they would have said, well, the likely outcome here is for us to land this plane. We're probably going to have to pull a Paul Volcker. We're probably going to have to put the economy through a deep recession.
Hike and hold into a recession, yeah.
And of course, the economy has defied all of their expectations, all of their models. And then the last regime, the immaculate landing, that is kind of like the bumpy landing, but it's cleaner. And you land the plane very nicely and smoothly. Inflation comes down with no negative consequences. This is a beautiful flight. It's a beautiful flight to be on. And you see these colors throughout time. We recently moved back into the no landing, which is not a good thing for markets. We were in this immaculate landing for an extended period of time. But then when we think about, what are the things, the big ticket economic data points that cause us to shift market regimes, those were all starting to come up no landing. So We'll talk about that a little bit later.
Yeah, exactly. And you can see some of what you're alluding to here, right? In the immaculate landing scenario, good for bonds, bond prices up and to the right, really, really good for stocks, right?
Yep.
Proportionally so. And then the opposite of that, like you were talking about with the no landing, you can see that April market performance where both stocks and bonds saw their prices fall. So if we kind of, broaden out that analysis, we can take a look at average returns for these two areas of the market under each of these scenarios. I will note we are annualizing all of these returns to try to make them as close to apples as possible. But you can see that holding true. Immaculate landing, stocks and bonds up. no landing, stocks and bonds down, right?
Exactly. Cash is king here.
Yep.
Bond yields are rising, meaning bond prices are falling. And bond yields are getting so high that they also create concerns that corporations aren't going to be able to refinance their debt. Earnings are in trouble. Inflation is rising here. It's nasty. When you think about all the bad market environments since 2022, they've pretty much been in a no landing. Compared to the hard landing, where, yes, that's bad for stocks because the market is really starting to bite on recession fears, but great for bonds.
Yeah. This is where you're getting lots of cuts and quick, right?
Exactly. Here, the silver lining here is, the belief is if you go through a recession, you defeat inflation. It's the hardest, nastiest way to land the plane, but it is a way to land the plane, right? And then you have the bumpy landing, which is sort of something almost as good as the immaculate, just a little different flavor. And so in our investment framework, that's been signaling 12 months out, the most likely economic outcome is something like a bumpy landing. But the market has actually very sporadically, sparsely behaved as if a bumpy landing was going to happen. Instead, the market, as it does, has decided to alternate pretty viciously between no landing, immaculate landing, little shade of bumpy landing, back to no landing.
Yep.
It's been far bumpier than our forecast would suggest, even if the forecast ultimately ends up being right.
Yeah, exactly. And it could likely average out to that slightly warmer water over time, right? But in the meantime, the market is going to jump back and forth between these regimes. So let's talk about, let's kind of rewind back to a month ago and talk about our decision to put us in, if you will, the no landing regime, right? And so what we're looking at here are kind of the three legs of the stool for the no landing regime, and might be kind of tough to think about given Powell's comments last week, but in early April, we were sitting here with inflation above target as it has been for some time, right? Hotter than expected for a handful of readings in a row. And rising based on the timeline that you're looking at, right? The shorter the timeline, the stronger the rise. So we would sit here in early April and say inflation certainly staunchly in the no landing conditions having been met. Looking at labor market, you could say all three of these were in place. We've talked a little bit about shortage of workers for some time now, right? Stronger than expected payrolls, hotter than expected wages, all taking place in the labor market, as of early April. So check all of those boxes off. And then the Fed, we were just talking last week about how important it was coming into Wednesday. Are they going to be hike biased? Are they going to speak more hawkishly? I mean, that was something that was within the realm of possibility. And then this idea here of focusing more on price stability and inflation as opposed to the labor market, where we've said the labor market is what's holding them back from being allowed to cut, or the inflation, is holding them back from being allowed to cut. The labor market might call on them, requiring them to cut. So we're sitting here in early April with all of this criteria met in the no landing. And Mike, why don't you walk us through what we've seen since then and where we could be now?
And the big thing we ask ourselves, very rarely do you get all of these checked off in enough time that you're ahead of the market. If you're waiting for all these to get checked off, then you're kind of looking through the rear view and saying, okay, clearly the no landing was a month ago, right? So what we ask ourselves internally is, have sufficient conditions been met to declare that the market is going to start to behave as if we are in a no landing regime? And sufficient conditions were met in early to mid-April. The last nail in the coffin was that March CPI report that we got in early April. But then we think about the last week, as you were saying, and a couple of big events. One was the Fed meeting. And Jerome Powell came out and he surprised, in our view, a bit dovishly, and reiterated that they are not hike biased. The Fed is not hike biased, and did not speak hawkishly. There are plenty of AI, large language learning type models that will put Fed statements and Fed speeches through the ringer and determine overall, was this speech, were these comments leaning towards, okay, they're thinking about hiking next or they're thinking about cutting next. Net, the press conference and the statement last week were more dovish, meaning they leaned more towards cutting. And then the last thing he spoke to, if there was weakness in the labor market, rate cuts would accelerate, which shows they are not singularly focused on prices. They are focused on both sides of the dual mandate, full employment and price stability. So then we move into the labor market. On Friday, we got the jobs report. That's the next big ticket release after the Fed meeting. And payrolls were weaker than expected, and average hourly earnings came in cooler than expected. The other thing on shortage of workers, that is far less severe than it was. You can look at the jobs workers gap. When you look at number of job openings per number of unemployed persons, that's come down back towards pre-COVID levels. And you look at things like the quits rate, which shows the amount of bargaining power employees have because they're in high demand, and that's come down quite a bit. So shortage of workers, you would say that was weakly checked anyway. It was sort of a weak check mark. And maybe it's still in place, but it's far less of a factor. And so the last thing that we would need to say we're exiting the no landing would be inflation to just come in line with expectations. If the CPI report that comes out on May 15th, the April CPI report, is not hotter than expected and shows a sequential decline in inflation, you would uncheck these two. Go for it. I'll just because I can't do it with my finger. And then we would say, all right, sufficient conditions have been met that we have exited the no landing. That's great because we go back. It's not a good place to be in. And that would move us back towards something like a bumpy landing. And it would also, what you would see is this talk about number of Fed cuts, rate cuts. So how many and when are they going to happen? And at the beginning of the year, the market said 6 and we said 3. And then recently the market was saying 1 and we're still saying 3. What it's going to look like is the market moving back towards our 3, which has already started to happen, especially after the jobs report last week. So we are hopeful that either the no landing is going to be short and sweet, and we're moving back into the bumpy landing. We're hopeful that the inflation report on the 15th moves us out of this not so fun market regime.
Exactly. So we would summarize all of that by saying, seems like the Fed wants to cut. Seems like the labor market is giving them permission to cut, right? The labor market isn't, particularly strong. We just need inflation to come down, like you were saying, not be hotter than expected and stop rising. And then not only could we move out of that no landing scenario, but it could be pretty quick and it could be pretty significant. Because as we've seen, the market just wants cuts. So anything towards that narrative is going to be very well received.
And this CPI inflation not coming in hotter than expected is consistent with our framework forecast. That's why we're willing to say we think we're going to move out of this no landing pretty quickly before we actually see it in the market, right? You can't wait for the market to confirm your views, then it's too late. However, we do have to say, of course, because we do this every week and it's hard to predict the future, if the CPI report comes in hotter than expected and then we're sequentially rising, then what's going to happen next? The Fed is going to start prices hike biased at the June meeting, speaking hawkishly, and we could stay in this no landing. Our view is obviously that won't happen, but we speak in probabilities, so think in probabilities.
And you can, looking through the rear view and checking in on returns for the last week, you can see a combination of all the things we're talking about, right? So over the past week, particularly the second half of the week, as the market took in the FOMC press conference and the jobs report, this idea of maybe moving out of the no landing a little bit, seeing some green across the board for bonds. You see the 30-year up over 2% as rates fell over the past week. But you compare that to quarter to date, right, where we were talking about how in April we were pretty firmly in the no landing environment, and that's where you're still seeing a lot of red for fixed income. And similar themes on the equity side as well, right? Past week, green across the board here for these major asset classes, quarter to date, red almost across the board. Awesome. So we'll wrap up with our investment framework components, starting with inflation. You just alluded to, you see our inflation forecast here getting through Q1 2025, just north of the Fed's 2% target, right? And you can see a particular drop off in the second half of 2024, more like Q4 2024, as we start to escape some of these base effects, right? And potentially see some of that softening inflation coming.
Yeah, this is key. The disinflationary process for core PCE in particular, which is the Fed's preferred inflation gauge. Keep in mind that right now is running about 1% below core CPI, okay? Because of how certain things in the core CPI basket don't necessarily map over to the core PCE basket. So that disinflationary process is key. The Fed doesn't need to wait until inflation is 2% year over year to start cutting. They just need to feel confident that the disinflationary process is underway. And we think the next few inflation prints are going to provide that for them.
Right.
Then they can basically look and say, all right, I got 3 cooler than expected months late last year. I got 3 hotter than expected, 3 or 4. And then I get 3 more in line. Okay, over 12 months, that evens out roughly. We feel comfortable starting the process of making adjustment cuts. That's the key theme.
Exactly. Yep. And on the liquidity front, of course, nice to see this recovery occurring. No major changes to our liquidity forecast. The taper of the runoff of the balance sheet right in line with our expectations. So this liquidity forecast relatively unchanged from last week. And then economic growth continuing to kind of settle in, if you will, to a projected level of economic growth that's far more sustainable than what we saw in late 23, early 24. Kind of in that 1.5% annual growth rate.
Slowing to something more sustainable, but still very acceptable.
Right.
In terms of what markets are looking for.
Yep.
And we need to see some level of slowing of economic growth to feel confident that inflation is going to come down. These things are related.
Yeah, exactly. That's what makes the immaculate landing so difficult to pull off.
Exactly.
Right? Yep. And we'll wrap with the recession signal. Highlight is it remains inactive. You can see heavy truck sales, has now triggered its level, but still needing one of the other two within the real economy for that recession signal to activate.
Yep.
All right. Well, that'll do it for this edition of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.